Today I'm going to talk about year-end gift planning strategies. Often advisors are confronted with clients who are looking for smarter, more effective methods to give back to society. Many have a large tax bill looming due to possibly a large bonus or sale of an appreciated asset, and they're looking for ways to minimize that large tax hit as the end of the year draws near. So this presentation will address several of these year-end opportunities. And as we move along, please feel free to submit questions over the chat. I'll try to answer some of the questions, but we'll definitely have time at the end for Q&A. Also, the slides from this presentation, as well as a recording of the webinar, will be shared after the webinar concludes. So with that said, let's go ahead and get started. As you know, the clock is ticking, and as we near the end of the year, there is a tremendous opportunity to engage with your clients and prospects in a meaningful way. While there are numerous reasons that donors prioritize their giving throughout the year, for most, a greater portion of all giving is done at the end of the year. Giving for many, as we'll review in this session, is often easy, but determining how and where to give is often a very difficult question to answer. The list of reasons people give are numerous, ranging from providing a sense of purpose to making a difference or impact in their community. But the fundamental reason for many at this time is the added benefit of the income tax charitable deduction. For this reason, it's vital for you, the financial practitioner, to better understand the various charitable planning strategies that can help you with your charitably inclined clients and help them maximize the income tax benefits in a way that will ultimately help them create more charitable leverage in support of their favorite charity or charities and causes. So just a brief overview and looking at the agenda, we'll quickly review the landscape for charitable giving. We'll also look at how donor-advised funds fit into that year-end conversation. We'll touch on the benefit of the IRA charitable rollover for your qualifying clients, and a review of how charitable lead trusts and charitable remainder trusts fit into the year-end discussion. As you know, charitable giving is woven into the fabric of our country's mindset. And Giving USA publishes results of their annual survey for charitable giving annually and has for several decades. And if we look at total giving for 2015, the obvious key takeaways are that total giving was $373 billion. Obviously that's a significant sum. Furthermore, 70% of the total giving came from individuals. From year to year, the percentages do fluctuate somewhat. However, the basic ratios are consistent year after year after year. 12 to 20% comes from foundations, 6 to 12 from bequests when people die, 4 to 10 from companies, but just about always 70 to 80% from individuals each and every year. So it's your clients, your donors, who are making these gifts to charity. The point is, Americans give to charity, individuals give to charity, and it makes sense to do so using tax-smart methods. A donor-advised fund, for example, is a smart way to give because it can separate the tax part of giving, which can be highly date-sensitive, from the actual charity support aspect of giving. For example, clients who may have an upcoming liquidating event, which may be the sale of a closely held business or property, may not have a clear vision of which charities they want to support. However, they do recognize the benefits of charitable giving. And by giving that highly appreciated asset prior to sale, your client can avoid a significant amount of capital gain on the sale and then decide in the coming months and years which charities they want to support and how much of those charities, or how much those charities, I should say, should receive. So let's take a closer look at the donor-advised fund as a planning tool. And as you can see, of the $373 billion, 5.5% of all contributions in 2015 went to donor-advised funds, which totals about $20 billion. That number is up about 14%, and that's a trend. Year after year, we see an increase amount contributed to donor-advised funds. The total market value held in DAFs are $71 billion, again up 24% from the prior year. Charitable grants to qualifying charities up a third, and the number of donor-advised funds continue to be created as well are up almost 9% compared to 2014. What I find most interesting is that the average size of a donor-advised fund is about $250,000, even though most programs offer a very low entry point to create a donor-advised fund. They make it very easy for an individual to create an account. Typically, that minimum funding amount is $5,000. What this signifies to me is that many of the affluent are using DAFs often to leverage a larger gift today, to take advantage of an income tax deduction, and in a year that deduction may have a greater impact for them personally, while distributing that gift into smaller portions from their DAF over a number of years. Donor-advised funds have increased in awareness and popularity really in every way and are becoming one of the more important planning tools in your toolkit. The bottom line here is that your clients, your donors are creating donor-advised funds, and really they want to know more about them. Often those who give to charity simply write a check, often multiple checks to their charitable organizations throughout the year. Ask yourself how many of your clients or donors are doing this each and every year. With a donor-advised fund, your client can put away the checkbook. The donor-advised fund is a great way to simplify their charitable giving in one centralized account through making a one-time contribution or a series of contributions over the years, and then simply going online to make grant recommendations to their various charities that they want to support. Through this exercise, they can make one-time grants to charities. They can set up scheduled or reoccurring grants. The grants can be anonymous or made in the name of their account. If I were to have my own donor-advised fund, it would be the Christie Family Foundation. So maybe grants are going out in the Christie Family Foundation or charitable giving account. They can be recognized as an individual, or they can even set up the grant to honor another family member or friend in their memory. So it's very flexible, a very flexible tool in how they're able to distribute those assets out. This way, the donor-advised fund essentially becomes like a charitable checkbook with added flexibility, which ultimately simplifies the annual giving process. I'm not going to spend a whole lot of time on this, but for those of you that aren't that familiar with donor-advised funds, what you'll find is donor-advised funds are very simple and easy to establish, since they don't require an attorney to draft any documents. It's simply just a 3 or 4 page application, or require any government registration, unlike a private foundation. A donor-advised fund is just a separate account or a segregated account with a sponsoring charity where the donor can choose their own name of their account and receive a charitable deduction typically equal to the value of their gift. Essentially, it's a dollar for dollar deduction. You put $1 in, you get a dollar deduction back. They're the best alternative typically to a private foundation, as they provide the same look and feel of your very own foundation, but without the headache of creating the structure, getting it approved by the IRS, all the rules and regulations you have to follow, and the expense. The sponsoring charity for the donor-advised fund program will handle all the compliance work, accounting, tax filing, facilitating payments of grants, and more, so that the donor simply has to focus on which charitable organization they'd like to select as a grant recipient. For those who aren't aware, we have many different donor-advised fund options through our foundation, the Renaissance Charitable Foundation. We have our own retail solution where we can help you establish an investment account with your preferred investment firm where you normally custody assets. where you have full discretion over the investment management of that account. Again, it's individually managed. The assets as well are, again, as I said, individually managed. There are simplified alternatives as well. We have other programs that are branded DAF programs with different investment firms, and they may offer a more simpler investment model where you can elect pooled investment options or just individual mutual funds. But there are a number of different donor-advised fund options out there for you through our foundation, the Renaissance Charitable Foundation. So as you can see from this flow chart, there's not a lot of moving parts to a DAF. A donor makes a contribution to a sponsoring charity. The sponsoring charity establishes, again, that separate account with you as the investment advisor in the name of that donor. Because the sponsoring charity is tax exempt, any contribution is going to create an income tax deduction equal to the value of the gift on most assets. And again, if you're transferring an appreciated asset, which makes sense in most cases, on the sale of that asset, you're going to avoid the recognition of, or your client's going to avoid the recognition of realized gain. In addition, the assets inside the donor-advised fund portfolio will grow tax-free. Over time, the donor, as the grant advisor, can make, again, as I suggested earlier, can make grant recommendations to their favorite qualified public charities. When the donor reaches the end of their lifetime, they can have their children step in and take over as grant advisors, and their children can do the same and pass that philanthropic legacy down to future generations. If the donor does not have children that they want to pass this role on to, they can essentially name their favorite charities to receive distributions based on a distribution schedule that they would provide, and so it becomes a designated or an endowment account that will fund their favorite charities even when they've passed on. It'll continue to fulfill their charitable their legacy beyond their lifetime. What types of assets can be contributed to a donor-advised fund? Really, any asset's a good candidate. Most common gifts are cash, stock, mutual funds. In addition, we can accept complex assets such as real estate, closely held stock, tangible assets. Because complex assets require additional steps to transfer, title, there's some due diligence that's involved in that, and procedural steps that need to be followed. Giving a complex asset will require a little more planning time up front. However, review and approval for most of these asset types really are just a matter of days, and so you don't want to take those off the table. They're still in play at this time of the year, even as we're nearing year end. So those asset types would include closely held stock. It would include real estate, might include tangible assets, possibly life insurance, maybe a policy that is no longer needed. The purpose of that policy is no longer in effect, and so transferring that life insurance policy might be a good asset. Collectible items, farm equipment, even harvested crops. We've worked through a number of contributions of unique and complex assets, and again, those assets are still in play at this time of the year. How do we start the conversation? And really questions that you can ask your client to kind of probe them, to move them forward into thinking about how they're giving to charities. Asking them what charities do they give to and why, and how are they currently supporting those organizations? Are they interested in hearing about, a more tax efficient, possibly a smarter way to organize and support their annual giving? If they're currently writing a number of checks, as we've discussed, Have they considered donating appreciated securities instead? Again, front-end loading a contribution to a donor-advised fund, taking the income tax deduction now when tax rates are at their highest. Who knows what they'll be like next year. So taking advantage and use of that deduction now, and then spreading their distributions over a number of years, again, utilizing their DAF as a checkbook. Do they have a windfall income event this year? Is there an anticipated bonus? Or was there a taxable event that occurred earlier in the year that unfortunately, we weren't able to get in front of, and maybe utilizing a CRT for that, and that taxable event, the sale of that real estate or closely held business occurred without any prior planning, and there's a significant tax event. A donor-advised fund could help minimize that with the income tax deduction. Are they considering leaving any money to charity in their will, or do they have a large qualified plan where maybe naming charity or a donor-advised fund as the beneficiary of that qualified plan might make some sense? And would they like to leave a charitable legacy? How do they feel about that? How do they feel about passing on their values, the charities that they value, those relationships they value to the next generation, and teaching their family about charitable planning and giving back to society? Utilizing donor-advised funds and really all charitable planning tools is only going to enhance your practice, because you're the one providing a tax-smart, simplified solution where they're going to experience an increase in tax savings and possibly even a greater capacity to give, because you're having those conversations, you're having deeper conversations with your client. You're creating a stickier relationship based on values-based conversations you're having. You're creating a venue for the next generation to get involved. Again, a donor-advised fund is a way to pass on that philanthropic inheritance to the next generation, and the ability to work with those children as clients. And again, you're creating the opportunity to increase your assets under management, taking an illiquid asset possibly and turning them into investment assets through a donor-advised fund. Obviously, you can do that through some of the other charitable planning tools, but it's a great way to unlock non-publicly traded assets in a very tax-efficient manner. So just a quick review of the features and benefits of a DAF. And again, it's a perfect tool for year-end planning because it's so easy to create. There's no legal work. There's no cost to establishing it, and administrative costs are low. Again, if you're transferring a highly appreciated asset, a client has a stock position with gain, transferring that to this tax-exempt entity and avoiding capital gain, you've got 100% of your assets at work inside that account for future giving. Again, you're going to it's going to help dilute concentrated positions. Fair market value deduction for contributions. Again, dollar for dollar deduction for a contribution of publicly traded stock. The same holds true for real estate, based on the appraised value of that real estate position or closely held stock. You don't have that benefit with a private foundation because you're not going to get that higher preferred fair market value income tax charitable deduction. And again, you're able to spread out your giving over a longer period of time. Again, a DAF there's value when you're talking to your client about their estate planning objectives, because again, you're moving an appreciating asset out of their estate. And if it's an IRA, you're going to avoid income tax in respect to a decedent, and you're removing that asset from their estate. hopefully you're able to replace that asset with life insurance if that's an objective of the client, to replace the value of that intended gift to charity. A donor advised fund can be the remainder beneficiary of a CRT and can also be the income beneficiary of a CLT, and we'll talk about that here in just a few minutes. You have the ability to name, again, children and their children as successors, so that the fund can continue in perpetuity, a way to build a legacy and endowment for the charities that your clients value, in a way to involve family members from the very start. So let's look at a typical conversation we have, a typical opportunity that involves a donor advised fund. We've got a couple of them here. But the Twain case strategy, and we've got hundreds of case strategies as an aside, and those are available to you. We're happy to share those with you. They cover all the different charitable planning tools, all the different possible funding assets. There really isn't a scenario that I can think of that we haven't worked through, that we haven't built a story for. But back to the Twain case strategy, it's a basic example of someone wanting to diversify from an appreciated stock position. They're charitable. They're going to use the DAF to diversify tax-free. They're going to take that large income tax deduction now, and again, in a year that they can use that income tax deduction, and they're going to get more bang for their buck in the use of that deduction and experience greater tax savings. So that in funding their DAF now, again, it's going to allow them to endow their charitable giving for years to come. Another example would be Mike and Julie Snap, and in this example, they're funding a DAF to create that large income tax deduction up front to help offset the tax costs of converting a traditional IRA to a Roth IRA. And a donor advised fund is one technique to create that large income tax deduction up front. And in this example, the Snaps withdraw enough from their IRA for the Roth conversion and to fund their DAF. So in doing so, they're minimizing the tax on the Roth conversion. If your clients have other appreciated assets, then it most likely would make better sense to utilize those assets to fund the DAF, to create that income tax deduction, which would further reduce the income tax event on the withdrawal for their conversion. And they can better time what they're pulling out and converting from their traditional IRA to a Roth. So let's look real quickly here at the basic rules for the IRA charitable rollover for those of your clients that qualify. Obviously, this strategy became permanent last year, and it's available for donors age 70 and a half on or before the date of the rollover. The real key thing here is that charity, the distribution from the IRA must go to a public charity and cannot, unfortunately, go to an account where an individual has discretion over, grant-making authority over. So it can't go to a donor-advised fund or a support organization. What we have seen is individuals creating an endowment-like account or a designated or restricted account where they've named a specific charity. You're continuing to manage those assets, just like a donor-advised fund account. We would open up an investment account, but this account is set up and is designed to specifically benefit a specific charity. The rollover must be, again, a direct IRA to charity transfer. So whether it's to the American Cancer Society or it's to the Renaissance Charitable Foundation to create this endowed account, it has to go directly to that charitable institution. The entire distribution must qualify as a deduction contribution were it not for this provision. Rollovers from SEPs and Simples don't qualify. The exclusion from gross income only applies to distribution amounts that would be, again, included in gross income. And there's a maximum distribution amount of $100,000 per individual that can be rolled to charity each year. For those individuals that have significant adjusted gross incomes, it might make sense for them to take their required minimum distribution as a taxable distribution and fund their donor advised fund that way. That way they're creating an income tax deduction. Their income is large enough to be able to utilize that full deduction, and so it would be a wash. And in doing so, they would have more of an advisory role. They could then select multiple charities to dole those distributions out to. But those individuals that want to utilize the rollover strategy, again, an endowment account is a nice option. And this case strategy is an example of that, where Joe Landy, again, doesn't need his required minimum distribution, and his required minimum distribution is $40,000. So rather than taking the distribution, he elects to create, again, an endowment or designated fund that instructs his IRA provider to make a direct rollover to this newly created charitable account. And this account is the Joe Landy Food Bank Endowment Account, and it will make permanent annual grants to this organization in his name or from his endowed account for years to come. So again, an effective way of creating a living account to benefit someone's favorite charity. Another great year-end planning vehicle is the Charitable Lead Trust. And again, typically it's for the purpose of creating a large income tax deduction in the year that someone may have a large taxable event. Typically the individual is charitable, but again, they have a need for a large income tax deduction. And here, looking at the diagram or flow to the CLT, what we're dealing with obviously is a trust. Unlike the donor advised fund, which is just an account, and a simple account that we create, a CLT requires an attorney to draft a trust agreement. And as an aside, we do offer a custom document drafting service for attorneys, and have done so for years. And I know we've worked with a number of you in creating these trust instruments. But we do so for attorneys as a method for them to quickly create a custom document, and it's a valuable service at any time of the year, but certainly an increased value at this time of the year when everyone's time is at a minimum. We do charge a nominal fee for that of $500, but again, it's a time-tested document and one that your attorney, I think, will see a lot of benefit from. So once the document is created, the donor would then contribute assets to the CLT. Typically, it's cash. Depending on your client's objectives, will really determine the CLT form. If your client's looking for an income tax deduction, and for the asset ultimately to come back to them, essentially loaning the assets to the lead trust to pay out the charity to receive a large income tax deduction up front, then what we're looking at or using is the Grantor Lead Trust format. Keep in mind that Grantor Lead Trust or CLT is a Grantor Trust. Again, it's providing a large income tax deduction based on charities, the present value of charity's income stream over the term of the trust. However, the income earned each year will be taxable to the grantor as phantom income. And as you know, there are a number of investment methods to keep that amount of that net income earned lower, so that that taxable event each year is nominal. But that's for a longer and deeper discussion at some other time. If the trust design is to get assets to the next generation, more of a transfer tax or estate tax play, then the non-grantor lead trust format is what we'd look at, because that's going to produce a gift or estate tax charitable deduction. Unlike the Grantor Trust, where the donor will pay income tax on net income, a non-Grantor Trust itself, the trust will pay tax on all income earned, but will receive an income tax deduction on income paid to the named charity each year. So the next step then, the charity is going to receive income from the trust, again, typically for a specified term of years. The amount paid can be a fixed annuity amount, commonly known as an annuity trust or CLAT. That's the most common type, or a unitrust format, which is going to fluctuate from year to year based on the value of the trust, known as a CLUT. And then finally, at the termination of the trust, again, typically a term of years, the assets are transferred back to the named beneficiary in the trust document. If it's a Grantor Trust, those assets are coming back to the grantor, again, loaning those assets to the trust. If it's someone other than the donor, it's going to go to that beneficiary, typically the heirs or the children. There are two specific types of lead trusts, as we talked about, the Grantor Trust and non-Grantor Trust. For year-end planning, usually the Grantor Trust is in play, so that's just what we're going to look at here. Real quickly, a Grantor Trust, again, it's a Grantor Trust for income tax purposes, as we stated earlier. The grantor is going to receive a current income tax deduction up front for the present value of the lead interest. So whatever that lead interest is over the trust term, the present value of that's what the grantor is going to be able to claim as the income tax deduction. The grantor, again, is taxed on all income, even though it's paid to a charitable organization. But again, there's ways to minimize that based on how you invest the assets. And again, the assets at the end of the trust term are going to come back to the donor. And the typical use, again, is for somebody that has a large taxable event and they need to offset that or minimize that. They don't want to truly give those assets away to, say, a donor advised fund, but they're okay making a gift to a trust that will bring those assets back to them. And as an aside, those income payments to charity can go to their donor advised fund. So it's a way to contribute assets that you're ultimately going to receive back that will, over the life of the trust, fund your own family foundation or endowment. So what are some of the factors in creating that income tax deduction? The more income that's paid out from the trust, the bigger the deduction. So the longer the trust term, the higher the payout rate, the bigger the upfront income tax deduction. Adversely, the shorter the trust term, the smaller the deduction. The fair market value of what's contributed does not equal the deduction, unlike a contribution to a donor advised fund. Again, it's the present value of the income stream to charity. And a key bullet point here is how the adjusted federal rate, the AFR, how that interacts with the calculation or the deduction created. In the environment we're in right now, a low interest rate environment, the AFR has decreased over the last couple of years. Right now it's sitting at 1.6. Next month it might be a little bit higher with rate increases. But the bottom line is, with a low AFR, that is going to produce a much larger income tax deduction. So this is the perfect environment, the perfect time to be funding your lead trust. Again, you're going to get more bang for your buck, a larger income tax deduction up front. And just looking at this chart, you can see, and I used the AFR of 1.6, you can see where how the payout rate, the lower payout rate, the lower trust term, what that deduction factor would represent. So a typical lead trust, we're seeing somewhere in the 4 to 6% range as the payout rate. Typically 10 years to 15 years. Sometimes people stretch it out to 20 years if they're looking for possibly a full deduction of their contributed amount. So at 5%, if you elected a 20-year term, you're going to have an 85% deduction. Put $1 million in, you're going to get an $850,000 deduction. So you can, I think this is a useful chart just to have on hand as you're having these discussions, and certainly contacting us to walk through what an illustration, how that would look like for your client. And certainly that's something we can model. Looking at a case strategy or donor story of someone that's utilizing a lead trust. Carl Evers, highest tax bracket with significant income, substantial investments, is receiving a bonus of $1 million, which will be heavily taxed. His strategy is, again, essentially to loan those assets to a grantor trust, lead trust, to create that significant deduction up front to help minimize that tax liability. And again, it's a scenario we see day in and day out. A slight twist to the grantor trust, as some of you are aware, is the super CLT. And this trust, you're kind of getting the best of both worlds, because it's a grantor trust for income tax purposes, but a non-grantor trust for transfer tax purposes. So you're getting both the income tax deduction and the gift tax charitable deduction. This is for somebody that has a significant estate. They need an income tax charitable deduction, yet they don't care about the assets coming back to them. They would like those assets at the end of the trust term to go to, let's just say, their kids, and do so at reduced transfer costs. So again, you're going to get the income tax deduction on the present value of the lead income interest and a gift tax charitable deduction. Because it's a grantor trust for income tax purposes, income as it's earned is taxed to the individual. And again, methods to minimize that by how you invest the assets. The remainder distribution, again, is going to go to someone other than the grantor, typically the children. Somebody that is utilizing this strategy, again, needs that current income tax deduction, and would like to get appreciating assets or assets out of their estate at reduced transfer costs, so they're getting that large income or gift tax deduction up front. Just quickly going, the break point probably is 22 or 23 years here, where you're getting almost a 100% income tax deduction and a 100% gift tax charitable deduction. So that's a great play for somebody that, again, wants to do some advanced planning. So let's just look at a quick example of a super CLT. The Davidsons here exercise non-qualified stock options, which created a significant taxable event. They have a large estate and like to set money aside for their children as part of their estate planning goals. The super CLT is designed, again, to provide that large income tax deduction, but also to help minimize the tax on the exercise of the options, while providing them with a large gift tax charitable deduction up front. So again, a great way to minimize tax and move assets out of the estate. The last planning tool or strategy we'll look at is the CRT. And I want to make this point that, again, we're nearing the end of the year. I talked about our drafting service. All these strategies are in play. Implementing a CLT or a CRT is going to take obviously more time than funding a donor advised fund. But if everyone's motivated, if the attorney is willing to work with us, we can crank out a document within a day or two. We can work through the funding process with you, transferring title. So even as we get into December and even the last part of December, it's never too late to initiate these types of strategies. And Just real quickly, most of you are familiar with this, but for those who aren't, the CRT really is the opposite of the CLT. The CLT is a taxable trust. The CRT is a tax-exempt trust designed to receive an appreciated asset and provide an income stream and an income tax deduction back to the donor and the donor's spouse. At the end of the trust term, typically the life of the donor and spouse as income beneficiaries, what's in that trust will go to their favorite charity or charities, again, which could be a donor-advised fund. And with some advanced planning for those who want to replace that asset to the next generation, if insurance is an option, and a separate transaction, they'd use enhanced income, maybe the tax savings from their income tax deduction, for premiums to replace that asset for the heirs. What drives the deduction here? Obviously, the less income that's coming, so again, it's the opposite of the CLT, the less income coming back to the income beneficiaries is going to drive a bigger deduction. If you're younger and you have a longer life expectancy, that means that more income from that trust is going to be paid to you over the life of the trust, so you're going to have a smaller deduction. If you're older, you're going to receive a larger income tax deduction because your life expectancy is shorter and charity's interest or future interest is greater. The AFR, again, it has a huge impact on lead trust, lead annuity trust, not much of an impact on charitable remainder trust, specifically unit trust, which is the typical trust format. It has a very nominal effect. For annuity trusts, which are used on a less frequent basis, it has a big effect on it, and we'll leave it at that. We won't go into that any further. Just a quick typical overview of a common conversation we have. Mark and Kathy Parker, they have an appreciated stock position of $1 million. They want to diversify, but are concerned about if they diversify the capital gain tax exposure. So transferring that stock to a charitable remainder trust and having the tax-exempt CRT sell that asset, they'll avoid the recognition of gain, which will they'll have 100% of those sale proceeds in the trust. And in this example, they elected to transfer 50% of their position. So they transferred $500,000. So they're getting an income tax deduction on the present value of charity's future interest. They're going to receive a lifetime income stream based on the value of the trust each year and the full value from the full value of the sale. Those assets that are in the trust are outside of their estate. And in this example, I believe they replaced that asset to their children with life insurance. So they peeled off some of that enhanced income from the CRT to make ongoing premium payments that will ultimately provide a tax-free death benefit to the kids. So again, not too late this time of the year to be talking to your clients about some of these advanced, not advanced strategies, but advanced planning tools, the CLT, the CRT. And again, remember, keep in mind that it's not all or nothing. It could be you're transferring a position of stock. You might transfer an undivided interest in real estate. Maybe the value is $1 million, and you transfer an undivided interest of $250,000 or $500,000, using the deduction to help offset what is sold outside the trust. So there's a lot of different planning opportunities. We just want to be involved in talking with you, helping you through those discussions through the case design, providing illustration support, ultimately through the implementation. Not going to spend a whole lot of time on this. This is just, again, an overview of who we are. Again, I mentioned that we have a foundation that offers a donor-advised fund program that was launched in 2000. It has just under $1 billion in assets. And we've given out, I think the really cool thing here is we've made distributions to charity of almost $580 million in all 50 states from our donor advised fund, which I think is really cool. We have about 21,000 planned gifts under administration, and of those 21,000 planned gifts, we don't manage a single dollar of those. You stay in control with your client. You manage the assets of whether it's a CRT, CLT, or donor advised fund. We're just helping you implement that and handling all the back end compliance for your client, doing a good job coordinating everything for you and your client as it relates to that particular gift. So I appreciate you spending 45 minutes. We went over a little bit. I'm happy to take questions. This is my contact information. There are other consultants here that can help you as well. We just want to engage with you with these year-end conversations, and feel free to email me or give me a call at any time. So looking at a couple of the questions here. Do we do pooled income funds? No, we don't have a pooled income fund, but we have a relationship with one of the largest pooled income providers, and happy to direct you to them through Eaton and Vance, through U.S. Charitable Gift Trust. So we do have a partnership with them, and can assist you if your client is looking for the large income tax deduction for a newly established pooled income fund. Does Renaissance offer DAFs? Is there a prototype document available? Again, there's no document required. It's a 3 to 4 page application. We can open an account within a day. So it's very easy to create, and then very easy for your client and for you, the investment advisor, to manage. Once a gift to a DAF is made, are the assets managed by the donor advised fund? Again, I touched on that. We don't manage the assets. We're investment neutral, custody neutral. You manage the assets through your channel where you normally custody assets, and you have discretion working with your client in how those assets should be managed. So I've gone well over. Again, I really appreciate your time. Feel free to reach out to me if you have individual questions, and I hope you have a productive and safe holiday season. We hope to talk to you all very soon. Thank you. Bye.